Good day, everyone, and welcome to this ATT webinar, The Desert and the Dragon. What do treasurers need to know about China-UAE trade? I say good day to everyone because this is the first time the ATT is simultaneously broadcasting a webinar that we hope is being listened to both in London, across Europe, in Dubai, across the UAE, and in Beijing and elsewhere in Asia. The webinar is presented to you in partnership with our very good friends at Arabia Monitor. My name is Peter Mather, and I'm the Speakers Chair at the ATT, and I will be moderating today's presentation and then discussion. There's a menu bar across the bottom of your screen that allows you to open various windows, and you can move these around your screen, you can resize them, or you can minimize them. The yellow button with a question mark is for help if you have any technical difficulties. The purple Q&A widget opens a new window. You can send questions to us by typing in this window, but please don't wait until the end of the session to send in your questions. Do send them in as and when they occur to you, and we will deal with them at the end of the presentations. We won't be disclosing any names of those of you who are asking. I should add that a recording of this webinar will be available on the ATT website in a couple of days' time, along with a separate copy of all the slides. So if you're unable to listen to the whole of the webinar or you'd like to share it with your colleagues, please do so by returning to treasurers.org. Our speakers today are Dr. Florence Eade Oakden, who's the CEO and Chief Economist at Arabia Monitor. And our discussion will also be joined by Roshan Tulkens, the International Treasury Manager for Developing Markets at Reckitt Benckiser, who is based, incidentally, in Dubai in the UAE. Some of you may already have seen Dr. Florence present for the ATT and at other events and conferences on treasury, finance and business matters regarding the Middle East. I'm now going to pass you over to Dr. Florence, who's going to present to you for a short while her current thoughts on the state of China-UAE trade. Dr. Florence.
Good morning, good afternoon, good evening, everyone. Thank you, Peter, for this kind introduction. And thanks to all our participants today dialing in seemingly from all over the globe. I very much appreciate the time you're allocating for this call. We have quite an impressive list of participants on the call and quite a large one. The coverage of China in the Middle East by Arabia Monitor is a theme that we started several years ago when we realized that the unfolding of the new Silk Route would most likely be the most significant tectonic plate shift for the Middle Eastern economies, in addition to all those other countries on the route between China and essentially Western Europe and Western Africa. The most important tectonic plate shift since the discovery of oil for our region, just because of the sheer amount of investment and trade flows that is flowing into our region because of the rediscovery of China of this part of the world. As you probably know, the old Silk Route was chronicled very interestingly and colorfully by Marco Polo, and the new Silk Route today is starting to be chronicled, and we pride ourselves on being experts in the domain, have a Chinese colleague on board, and consider that a significant component of what we cover at Arabia Monitor. Broadly, we cover economic and market-related research on the Middle East and North Africa, including the relationships between the Middle East and North African countries and the rest of the world. And we also cover geopolitics and geopolitical risk, of course, because this is a part of the world where it's absolutely crucial to understand that in order to provide a full picture of development in this region and the way the region impacts the world and vice versa. The theme of today is brilliantly conceived by ACT, the Desert and the Dragon, and we do focus a lot on the UAE, independently of the Chinese link, but the Chinese-UAE link is really quite unique. If I can invite you to go to slide 2 of our presentation, you'll find on that slide a map of the One Belt, One Road strategy laid out by the Chinese government a few years ago. When this first came up, no one really knew what it was about, including in China. I was in China at the time, attending a conference invited by the government of China, and I would ask, what's this new strategy about? And very little knowledge was available on it. Slowly, it started to become clear that the strategy would essentially unfold from investments being made by the Chinese government and by Chinese state-owned enterprises, and that the investments would be significant, and that the MENA region would benefit significantly from this strategy. So if you take a look at the map, you'll find that Saudi Arabia, Iran, Iraq are smack in the middle of the two routes. There's a red route, that's a landline route that now includes a train route that runs from London all the way to China, inaugurated only a few weeks ago, forgive me. And there's a blue route, which is the maritime route, which goes through the strait between Yemen and Africa, the Horn of Africa, goes through the Suez Canal up in Egypt, and continues on through the Mediterranean to Europe. These are extremely important routes for our part of the world because as they unfold and get populated, Chinese investments are being deployed along the route in order to create both trade and financing opportunities, but also employment opportunities for the Middle East and North Africa. Now, let me go on to slide 2 to just give you a bit of granularity. The next slide, which is slide 3, you'll find that Sino-Arab trade, so trade between China and the full set of Arab countries, ranging from Morocco down to Yemen and Oman, Saudi Arabia, also up to Iraq. It has grown 8-fold since 2003. So in just over a decade, we've had an 800% growth in trade between China and the Arab countries. This is significant in various ways because it has brought with it investment, it has brought with it better knowledge of opportunities between the two parts of the world. It has brought with it more tourism. A lot more tourists are coming from China to the Arab world than ever before. And it's also important because of what it has done to trade figures and GDP growth, both in our part of the world and in the countries that are also benefiting along the way from the trickle of opportunities that are unfolding. One of these countries is Pakistan. If you move on to slide number 3, the next one, forgive me, which is slide 4, numbered 4, you'll find that we zero in here on Sino-UAE bilateral trade. And here we've seen an impressive 14% annual growth between China and the United Arab Emirates in terms of trade volume over just over a decade, once again. We expect this trade volume over the next couple of years to continue to accelerate. The bar for 2017 there is a forecast. We expect 2017 end-of-year figures to either meet this forecast or to surpass them. And we expect 2018, 19, and 20 to continue to show the same type of acceleration in trade between the UAE and China. If you move on to the next slide, which is slide 5 here, we have a breakdown for you in a pie chart of the top UAE import partners. So these are the countries that import the most from the UAE. And so you'll find that China is top amongst these. And next in line is Germany, and the UK is high amongst these. Obviously, India is a significant trade partner to the UAE at 13.3% of imports. Indian trade between the UAE and India is accelerating quite rapidly. However, the most rapid acceleration we find is with China, and we expect the acceleration to continue. Now, if you take a look at the figures on page 6 of our presentation for Hong Kong, you'll find that that is also quite impressive in terms of exports to the MENA region from Hong Kong. UAE receives the highest proportion of exports from Hong Kong to the MENA region. That's roughly 6%, 60% of all imports coming from Hong Kong to the MENA region. All others combined constitute 26%. Saudi Arabia constitutes 9.1%, and Egypt roughly 5%. Iran continues to be a small proportion, but we also expect that to grow as the Iranian financial sector starts to open up. The impediment with respect to Iran so far has been that the sanctions have not delivered what was expected with respect to the opening of the financial sector, and Hong Kong, as you know, is to a significant degree a financial sector economy. Now, if you turn over to slide 7 and take a look at the average annual growth in UAE oil exports, so if we zero in on the oil trade, what you'll find is that despite the slowdown in China starting a couple of years ago, despite the fact that the Chinese have aimed for lower GDP growth, averaging between 6 and 7 rather than between 9, 10, 10.5, which is what we had during the supernormal growth year in China immediately preceding the financial crisis, and at the top of oil market prices, which peaked at $147 per barrel. If you take a look at this chart, what you'll find is that actually China has been quite a loyal partner in the oil trade for the UAE. So between 2005 and 2015, we've had roughly a 2% acceleration of total UAE exports going to China. So from just over 1% of its exports going to China, meaning 1% of what China was importing going from the UAE to China, to about 3.1, 3.2% from the UAE going to China, constituting 3.2% of Chinese imports in 2015. In 2016, despite the deceleration of Chinese growth, despite the lower oil prices, the level of imports from the UAE to China held up quite well, and we expect that this will continue to hold up. So the average annual growth in UAE oil exports to China has been quite significant at roughly 87%, and we between 2005 and the years 2015, 2016, and we don't expect this to slow down very much, even if oil prices continue to be where they are, and even if Chinese growth does not pick up significantly from here. Now, if we try and cover a different aspect of this picture, and we take a look at Chinese tourist arrivals, as part of what's happening in China, as part of what you will probably recognize as the China Go Abroad policy, is that not just Chinese investments are going abroad, Chinese individuals are going abroad, and not just for work, but for tourism. And so many of the Arab countries have now, as of the past 2 years, made it possible for Chinese tourists to arrive without a visa. And this has been a major development. Morocco is certainly benefiting from that significantly. And the UAE has been and will continue to benefit from that quite significantly. I think that they put through this measure about 3 years ago in the UAE. So Chinese coming to the UAE do not require a visa, or can get it quickly at the airport, that is. And so if you take a look at the resultant increased inflow of tourist arrivals from China to the UAE, you'll find that in terms of year-on-year percentage growth, it towers ahead everything else that we're seeing. Obviously, this comes from a low base. If you take a look at the Chinese bars, the blue one, then the orange one, and then the estimated one for 2Q 2016 based on the growth in 1Q of 2016. So if you take a look at those, a distinct continued improvement and a very sizable one in terms of a percentage growth between 2005 and 2016. We expect all of this to continue. There's something like 15% of the population of Dubai now that is Chinese. There's no less than 3,000 companies, small and large, in Dubai registered that are Chinese companies. True, the bulk of these are small and medium enterprises, but they are enterprises nevertheless in economies in our part of the world where about 90% of the economy tends to be small and medium-sized anyway. And these are all very significant developments, because with these come flat purchases, with these flows come further flows onto Africa. So Dubai is an important stopping point, not just a destination, but also foreign direct investment. And the UAE is benefiting significantly from the foreign direct investment that is flowing into the region and into Africa, because Dubai is such a good stopping point. In Dubai, we have the only malls in the region where in a lot of shops you've got Chinese speakers serving customers. And in Dubai, we have probably the only significant set of hotels in the region that prepare special programs for Chinese New Year, and where that is becoming an increasingly significant destination for celebration by Chinese. Now, I will leave it at that for now and hand it over to my colleague on the panel. Very happy to come back to you any time with questions on this. Amongst the topics I didn't cover are a bit more on Iran, the China-Pakistan Economic Corridor, which is called CPEC, and how that interacts with the Arab region, alternative routes for oil exports from the Middle East to China, other than the South China Sea and the Strait of Malacca, all of which China is looking to avoid. And there are about 7-8 different alternative routes in the making that the Chinese are investing in. Investments in Oman, which have been extremely significant, which constitute the very first investments by the Asian Infrastructure Investment Bank founded by China, and constitute a significant proportion of FDI into Oman. So with that, I'm happy to stop here and resume if there are questions on any of the above. Thank you very much.
Dr. Florence, thank you very much. Now, before I bring in Roshan Tulkens, I wonder if I might follow up just with a couple of quick questions, if I may. You talked in your presentation about the One Belt, One Road strategy, and we have seen recently some very broad publicity for the first shipment by train of goods coming from China into Western Europe, and your map, of course, shows a sea route. So I'm wondering whether you have any comments on what you think that might mean perhaps for logistics, or whether there's a preference one way or the other. And if I can follow that up as well by suggesting perhaps, and I think you referred to this as well, that the UAE and Dubai in particular could also be seen in some ways as a sort of Middle Eastern Rotterdam type port, entrepot port, with a lot more goods shipping in and out rather than staying, with the exception, obviously, of hydrocarbons which are going out. Do you think those two play together, and do you think the Chinese will be looking to make much more FDI in terms of the logistics of the One Belt, One Road strategy?
I think that the One Belt, One Road strategy is a very, very significant logistics and transport sector story. So anyone on the call who works for a logistics and transport type company, I would recommend that they take a look at this map very, very closely because both the sea route and the red line, which constitutes the land route, are extremely significant logistics and transport stories in terms of investment and flows going forward. Now, with respect to, so I hope that answers the question with respect to the red line versus the blue line on the map on page 2, Peter. Both are extremely significant logistics and transport opportunities of different sorts, obviously. One is maritime, focused on ports, the blue one, and one has to do with land ports of all sorts, train stations and otherwise. With respect to Dubai acting as a center for entrepot trade, the fact of the matter is that Dubai has always been that, has always been mostly that, because the UAE is a small economy, and so is Oman for that matter, the port of Salalah. These are small countries and small economies, which, true, they service Saudi Arabia, and Saudi Arabia has put up its own fairly significant port on the Red Sea along the blue line. Just before you get to Egypt there, if you take a look at the Red Sea section of the map, there is the King Abdullah port, which is part of the King Abdullah Economic City. I visited it personally, really large, impressive, very deep, has docked some of the largest ships in the world already. These countries are significant for our region. However, in the larger scheme of things, they are not the largest economies in the world, which is why this flow is significant for them, which is why they benefit disproportionately, because when you have a small economy like the UAE or a small economy like Oman or a relatively small economy in the larger scheme of things, certainly compared with China, like Saudi Arabia, and you've got this traffic flowing through them, be it as onshore trade or entrepot trade, it makes a difference. It makes a massive difference, which is why Egypt has become very keen on joining up with this route and on receiving investments from the Chinese into Sinai, into the expanded port of the Suez. As you know, it was expanded starting a year and a half ago, which is why, for example, Egypt has asked to become a member of the China-Pakistan Economic Corridor. That's not something one would have expected only a few years ago. What does Egypt have to do with Pakistan? Well, what Egypt has to do with Pakistan today is this blue line on the map. So I hope this answers the question. I'm happy to come back to it. And any further questions?
Yes, it does. I have one question online which follows on from that. So, Roshan, if you could be patient just for a moment or two longer. This question follows directly on from that. And the questioner asks, with Iran potentially rejoining global trade flows, what is the likelihood of the Belt and Road strategy linking up through Iran and potentially via Pakistan? Well, you've already mentioned the point just there about Pakistan, but more generally, the Iranian question. Let's not get into the whole of the Iranian question right now. We only have 25 minutes rather than all week. But just that specific point on trade, would you see that to be something that's going to get some focus?
Extremely, extremely significant, and will get a lot of focus. I was actually in Iran only a few weeks ago, giving a similar type of talk on the importance of the return of the new Silk Route and the significance of the One Belt, One Road strategy for Iran. Iran is a neighbor to Pakistan, as you know, and the China-Pakistan Economic Corridor and Gwadar in particular, the Gwadar port there, are just on the border. And so the opportunity is absolutely significant because it accelerates oil exports out of Iran to China. It will augment the opportunity for the Chinese to come back with investments. But incidentally, it also creates a bit of a political pickle with the Iranian, which the Iranians have to think carefully about. All of these major geostrategic tectonic plate shifts obviously create political pickles. Iran has a good relationship with India, and rapprochement with Pakistan is obviously being watched carefully. The role China is playing in this CPEC economic corridor in southern Pakistan is one that is watched very carefully with India. China is trying to encourage India to become a partner rather than an adversary with respect to this initiative in southern Pakistan. China is also trying to encourage Iran to become part of it. It's a delicate balancing act that Pakistan and Iran have to play, given the neighborhood they live in and its slightly complex politics at times. But if we were agnostic to the geopolitics and looked at this purely from an economic prism, the opportunity is absolutely incredible for Iran, particularly because an agnostic prism would allow us to ignore the political pressures that come from massive investments from a country like China into Iran, a country starved for investments for the time being. What Iran obviously would prefer is to have a better balance of investments coming into it. But the fact of the matter is that China has been the only and most loyal trade partner to Iran. And at a time, the only foreign direct investment coming into Iran has been from China. This is not what Iran prefers. This is not what any country prefers, to have all of its eggs in one basket. But these are some of the dynamics around this theme. Happy to come back to it if you'd like me to speak for longer, Peter.
That's a very good answer. Thank you very much. We'll move on momentarily now, and I want to invite into the conversation Roshan Tulkens, who, as I mentioned before, is the International Treasury Manager Developing Markets for Reckitt Benckiser, who himself is based in the UAE in Dubai. Roshan, having heard what Dr. Florence has had to say, perhaps you would balance that maybe with one or two opening remarks of your own about your general impressions of doing business with China and some of the issues more practically that treasurers and corporates face in terms of cash and foreign exchange in doing business with China, and then potentially we'll develop the conversation from there.
Yeah, absolutely. Yeah, thank you, Peter. So yes, to give some more background, and as you mentioned, I'm sitting here in the regional hub for Reckitt Benckiser, which looks after the whole of developing markets. So one of these markets is China, and from what we see from our side, we actually see both sides of it. So not only are we manufacturing in China to sell to the wider world, we also manufacture out of China to sell into China as well. So I can give some background on both sides of that. But what's been quite apparent is obviously the desire for consumer goods in China. And while the desire for these goods and the cash generated is very, very positive for business, some of the, I would say, more practical treasury issues is the results of having cash trapped in China. And the difficulties, I would say, mainly, in the last 12 months with window guidance coming into place, you see what we call trapped cash building up in China because there's restrictions on getting dividends out of China, intercompany loans out of China quite recently. So it can give treasurers a headache in terms of actually repatriating cash, whether it be to the UAE in Dubai or to other regional treasury centres or head office as well. So more recently, in the last quarter, we've also been facing some issues on intercompany payables as well. So not just permanent repatriation, but actually trade payables coming out of China as well, which from an internal perspective can cause large balances on both sides adding up. And just kind of continuing on to that as well, the FX piece from a treasury's point of view can often be quite complicated as well, with regulations that are brought in by both SAFE and the PBOC locally in China, where there's restrictions on sometimes repatriating dollars or Chinese renminbi. So there can be decisions that need to be made in terms of functional currencies and remitting currencies between markets as well within the region.
Roshan, thank you for that. Perhaps I can follow up with a couple of supplementary questions before we develop the conversation further. You talked about some of the issues with cross-border transactions. Do you have difficulties within China in terms of funding subsidiaries, investing in subsidiaries, and working with domestic Chinese corporates, or is this really a cross-border issue that treasurers need to worry about?
Yeah, a good question. I mean, from our side, what we're seeing, it's mainly cross-border, and it's actually more on funds coming out of China. So if you're a corporate needing to fund a subsidiary or get money into China, the barriers are very minimal. It's actually quite a simple process to do. But on the repatriation of cash, this is where the difficulties are faced. So where we're actually paying local suppliers, there's no issues. It's really on intercompany or third-party cross-border payables that there are some restrictions on. And I mean, I'd like to talk about, potentially some of the solutions there. And what we're kind of seeing is having more than one bank potentially in these markets does help, because each bank has, for example, different quotas on foreign currency that they can repatriate on behalf of companies. So by having potentially a local bank, a more international bank, this can alleviate some of the issues that corporates are facing just by kind of spreading some of the exposures across multiple banks.
I was going to ask you, actually, that was going to be my next question about banks in terms of, perhaps more broadly, financial infrastructure. Are you finding ease of working with international banks in China, Chinese banks in China, and Chinese banks outside China? Because clearly the part of the One Belt, One Road has clearly got to be the development of a Chinese financial services infrastructure, both domestically, but also able to compete internationally. How do you balance the usage of your financial institutions?
Yeah, and this is, again, one of the difficulties that many corporates face. So when you're looking at global banks, there is a large portion that can be supported in terms of, as we spoke about, the cash repatriation, making payments, the e-banking systems, these sort of aspects. But when you're looking at, I would say, some of the less developed cities, such as some of the tier 3 cities you've got in China, some global banks, international banks, haven't quite got the network that some of the more local banks in China have. So what we're kind of faced with is almost a hybrid between using global international banks and also local banks, depending on the accessibility of, say, branches, using cash, and just infrastructure from rolling out, electronic banking platforms. So it's very much in the middle, and it's certainly not as developed as I would say, other markets such as Singapore and Hong Kong, where you could potentially use a global bank for pretty much everything from an electronic perspective.
Thank you, Russell. Dr. Flores, I wonder if I could ask you a follow-up question on this. You talked a few moments ago about the loyalty of the relationship, trading relationship, for example, between China and Iran. Are you of the opinion that this expansion through the One Belt, One Road idea is a specific Chinese governmental approach, or do you think they will in time encourage private sector involvement or even private sector to drive the development of that strategy for trade, both-way trade, but also through, as you were talking, through the UAE in particular, into Africa and perhaps into Western Europe?
That's an excellent question. Thank you for asking it. I think the point of the departure of understanding the reply to this question is to remind ourselves that the Chinese economy is a state-owned economy and still is an étatiste, top-down type economy. However, it is clear that the Chinese government understands the importance of driving the private sector as it restructured, as it continues to restructure its growth from one that is consumption-based, driven by government investments, to one that is truly private sector based, including in consumption. And so, as a result, the One Belt, One Road strategy has a distinctly private sector dimension to it. And in any case, one would expect that in China, like in any other part of the world, the economy has its share of entrepreneurs, and certainly in places like Guangzhou and Shanghai, one sees a lot of that. There's a lot of entrepreneurship in China. In terms of how the state is pushing this via the One Belt, One Road strategy, it's clear that the leaders of investments, the large ones, the big ticket items that are being deployed in places like ports in Oman, infrastructure projects undertaken by large Chinese companies on the western coast of Saudi Arabia, for example, on the border with Yemen, where there's a new port being developed, and in other parts of the region. It's clear that the big ticket items get handed to the state-owned enterprises of China because they are big ticket items, because the risk that needs to be underwritten is large, and this type of risk typically gets underwritten by governments or multilaterals, and hence the role of the Asian Infrastructure Investment Bank, which is the new multilateral majority owned by China, with quite a lot of Chinese equity in it. However, you did hear me mention that in Dubai, you've got something like 15% of the population of Dubai Chinese today, that we've got something like 3,000 companies registered in Dubai. Now, maybe 10, maybe 15, maybe 25 of these companies are the very, very, very large state-owned ones with representative offices of companies like CNPC, like the Agricultural Bank of China, like the Bank of China, etc. But the balance of that is, perforce, going to be smaller companies that are privately owned Chinese companies that might be doing business with the larger Chinese companies, or might be doing business with other large companies located there. But the push is not entirely public sector, although the initial push is most absolutely public sector, just because of the ticket items and the size of these tickets involved and the risk that needs to be underwritten.
That's very helpful. Thank you very much. Roshan, we've got an interesting question come in here about the cash and the repatriation issues you were mentioning. And effectively, the questioner would like to know whether the issues that you talked about are relatively recent, or whether they are continuing issues, but perhaps maybe have changed a little bit in character over time. You also mentioned the Chinese authorities' approach to foreign exchange management, which we know has been broadly positive in terms of opening up the market, but has had occasional setbacks. So are you seeing something that's, if you like, a continuation of consistent issues, but with occasional new roadblocks?
Yeah, I think that sums it up quite well. I mean, yeah, these issues have been around for many years, but I think with some of these repatriation problems, it seems to ease for periods of time. So the controls relax, so it allows companies to repatriate for a short time, but then the restrictions come back in, and they're not always the same as they had been previously. So to go back to my example earlier, I mean, in the last quarter where many intercompany problems had come in, that seemed to be relatively new. It's not something that was experienced maybe at the end of 2015 where we had similar repatriation issues. So it does keep treasurers on their toes, and it's a case of understanding from banking partners how they've changed from previous instances.
And you mentioned in a previous conversation that we had that there are some potentially positive developments in domestic or even international e-commerce, which sort of might cut across some of those. Without going into it in any great detail, do you feel that that's going to be positive for corporate treasurers in terms of doing business with China?
Yeah, I think so. I mean, e-commerce is going to be positive from the sense that I would say having products being sold on online platforms rather than direct sales to distributors and supermarkets, it makes the management of cash potentially easier. So rather than having to go around and collect cash from various distributors or customers, having everything coming into essentially one e-commerce account certainly simplifies things for treasurers in terms of getting cash in. Obviously receivable terms and things like that shorten because it's essentially instant cash that comes in online. So these are the sort of positive changes I think we're seeing from the increase of e-commerce business in China.
All right, thank you very much, Roshan. Well, I'm sorry to say that we are coming very rapidly to the end of this webinar. So I'd like to say my thanks to our presenters, Dr. Florence E. Oakton, CEO and Chief Economist at Arabian Monitor, and to Roshan Tilkens, International Treasury Manager at Reckitt Benckiser, and in particular to Arabia Monitor for their continued support of the ACT. We're very happy to have you as our good friends. I'd also like to thank all of you who've joined today's session. I'm sorry if there were questions that were asked that we haven't been able to get to. I mentioned at the start we will be recording this webinar on the ACT website along with the presentations in a couple of days' time, and you will receive the link. So please do pass that on to your colleagues within your organisations and other corporate treasurers that you know for them to engage with. I'd just like to draw your attention to the current slide, which is a series of forthcoming events that the ACT is having, and in particular I'd like to draw your attention to the Middle East Technology Breakfast, which is taking place on the 23rd of May in Dubai, and also the ACT Middle East Summit at the end of November in Dubai. And for those of you in Asia and in Hong Kong in particular, the Asia Treasury Leaders Forum in September in Hong Kong is also one that you can already book for and attend and join more than 250 delegates as we had last year. Well, thank you all very much for listening. If you can spare a moment to provide some feedback on the webinar, we'd be very appreciative. Please select the feedback widget, which is in green at the bottom of your screen, and please answer the question on that. The facility to do this will remain open for a short while after the webinar ends. From all of us here, thank you all very much and goodbye.